So these companies, I think, are obviously far bigger, have huge top-line revenue growth, but they don't. What they all have in common is they don't have the profits yet to justify these multiples of 20, 30, 40, 60x revenues. So I think the market has gotten totally frothy with these dot-coms. I also think the people who are talking them up the most are the venture capital firms that want a big exit and to cash out. And I think that the new investors who are piling in, I think, are getting a little bit, dollar signs in their eyes, and they want to get rich quick too. And I think all these companies are, you're going to have to be willing to hold them for many years to really see that return.
Well, and actually, Leslie, you have some data on that I thought was pretty interesting. The average first-day gain going back, let's call it roughly a 20-year period, so after that dot-com frenzy, average first-day gain 14%, average 3-year gain 21%.
So you get 7 percentage points on top of that. And if you look at it on a market-adjusted basis, so whether you get any alpha over a 3-year time period, turns out you actually don't.
Wow.
It's exactly equivalent to where the market is over that same time period. So to Stephan's point, most of the gains are actually made on that first-day pop, which is why investors who are attending these roadshows place such importance on actually getting allocation in those IPOs.
But the public can't get in on the offering price. They can only get in once it started trading. So we saw this with Lyft. If you went from, it opened at 87, that's the first chance the public had to get in. If you sold it at 72 and flipped out of it, you would have done all right, but it's the longer-term question. Stephan, let me just push back a little bit on this. It's true that for companies now this mature, in a way it's worse that they're still not profitable, but there are some bright spots. Look, the fact that Slack and Airbnb don't even have to raise money, Slack has apparently 8.5 years worth of cash on hand at its current burn rate, and there's been a bunch of enterprise software companies that are also doing pretty well. So, in a way, the most high-profile ones are some of the worst offenders, aren't they?
Yeah, I mean, Slack and Zoom are companies that have, they're much more enterprise software companies. They're also much smaller in terms of overall revenue and either losses or small profits. But they're still getting these outsized valuations of 60x revenues. So I think even they will see a right-sizing post-IPO. But the worst offender by far is Uber. I mean, they are the 800-pound gorilla. They're also the most overhyped. And they're losing $3+ billion a year. So with all this capital, they're going to burn through it, trying to compete in a no-margin business against Lyft and other competitors. And I think that Uber is going to be one of the companies that crashes and burns for a couple of years before they can prove out that they could generate billions in profits. I think they're going to be the ones that are going to get investors into the most trouble.